You know, it's a funny thing about human psychology. Usually when you walk into a really high-end, exclusive restaurant, like the kind of place with 3 Michelin stars, crisp linen tablecloths, and a tasting menu that costs as much as a mortgage payment, you just sit down.
Right, you just admire the ambiance.
Exactly. You look at the wine list and you wait to be amazed. You don't, march to the back of the building, push open the swinging doors, and demand that the chef show you the hygiene rating on the walk-in fridge.
No, you definitely don't ask to inspect the cutting boards.
Right. You just trust that because it's so expensive and because the dining room looks immaculate, well, the kitchen must be immaculate too.
It's a comforting illusion, really. I mean, you're paying for the final product on the plate, not the messy process of how the vegetables were chopped or, how the sauces were reduced. In those luxury environments, we actually prefer things to be invisible. We want the magic.
We want the magic, not the mechanics. But then you step into the world of elite wealth management. And specifically today, we're looking at the heavily guarded playbook of portfolio management services, or PMS. And suddenly, blindly trusting the chef just because the dining room looks nice is a genuinely terrible idea.
Oh, absolutely. It's a disastrous idea. Because here, the ingredients are quite literally your life savings. And honestly, the operational kitchen behind these pristine investment portfolios can be incredibly complex. It's deeply layered and just fraught with hidden risks.
It's a super high-stakes environment, and the reality is, if you are going to participate in this tier of finance, you cannot afford to just sit at the table and wait for the returns. You need to know exactly how that kitchen operates.
Yeah, you need to know who's allowed in the room, how they're monitored, how they calculate the bill, and crucially, what happens if the meal makes you sick.
Exactly. So welcome to this deep dive. Today, we are tearing apart the operational rulebook of portfolio management services. And specifically, we're looking at Chapter 8 of the Distributor's Certification Workbook. But this isn't just a dry run through regulatory compliance, right?
No, not at all. It's a masterclass in how your money is actually protected day to day.
Right. We're going to look at how superstar fund managers are kept in check, the surveillance systems tracking their every move, and the hidden levers that dictate whether your wealth actually grows or just gets eaten alive by administrative drag.
What's fascinating here is how the regulatory framework has evolved. It's had to adapt to create a near-bulletproof glass wall between you, the investor, and the portfolio manager handling your assets.
Yeah.
Because picking winning stocks is only half the battle.
Yeah, in a massive bull market, a lot of people look like geniuses.
Exactly. But what we're examining today is the permanent infrastructure of trust that exists regardless of market conditions.
So if you're handing over a massive chunk of your wealth to a professional manager, you need to know what happens when the doors close. Let's start right at the front door. Because, you can't just walk in off the street and open a PMS account like a basic savings account, right?
Oh, no, you cannot.
There's a VIP list, and there's a rather imposing bouncer checking IDs. So who actually gets to cross the threshold here?
Well, the regulatory framework sets a definitive boundary right at the entrance. The categories of entities that can invest are actually quite broad, though. You have individual resident investors, obviously.
Okay.
You have non-resident Indians, or NRIs, though they're subject to specific foreign exchange guidelines. You also have Hindu undivided families, proprietorships, partnerships, trusts, body corporates. So the structural avenues for entry are wide open.
So anyone can technically apply?
Technically, yes.
Yeah.
But the real barrier, the bouncer at the door, as you put it, is the capital requirement. The absolute strict minimum investment to open a PMS account is 50 lakh rupees.
50 lakhs? That is not a small amount of money by any stretch. That's 5 million rupees just to get a seat at the table.
It's a very steep cover charge.
Yeah, so it's essentially a VIP club where you have to prove you have the bankroll before they even show you the menu. But why is it so high? Mutual funds let you start investing with 500 rupees. Why not set the PMS minimum at 5 lakhs? Isn't this 50 lakh rule just inherently elitist?
I get why it feels that way. But that 50 lakh barrier exists for a deeply pragmatic, protective reason. It really comes down to the fundamental difference in the investment vehicle itself.
How so?
Well, mutual funds are designed for the masses. They're heavily standardized, highly diversified across dozens of stocks, and tightly constrained in the risks they take. But a portfolio management service offers bespoke, highly concentrated, and inherently riskier strategies.
When you say concentrated, you mean instead of owning tiny pieces of 100 companies, the PMS might take your whole 50 lakhs and bet it on just 10 specific stocks.
Precisely. The manager is taking high-conviction bets. So the potential for outsized returns is higher, but the volatility and the potential for massive drops in value is also significantly higher.
Right, it could tank.
Yeah. So the regulator uses that 50 lakh minimum as a blunt proxy for financial maturity and risk capacity. The underlying philosophy is that if an investor has the liquidity to casually place 50 lakhs into a single aggressive portfolio.
They presumably have the broader net worth to absorb the shock if it drops by 30%.
Exactly. It's a protective measure. It stops a novice investor from accidentally putting their entire life savings into a high-risk strategy.
Okay, that reframes it completely. It's a velvet rope designed to protect the people outside of it just as much as the people inside. So let's play this out. Have the 50 lakhs, I've got the net worth, and I'm ready to jump in. Do I just wire them 50 lakhs from my checking account?
You certainly can. Funding it entirely in cash via a bank transfer is the most straightforward method. But the rules offer significant flexibility. You can bring in cash, or you can bring in existing securities, meaning stocks or bonds you already own.
Oh, wait. Or a combination of both.
Yep, combination of both, as long as the total value crosses that 50 lakh threshold on the day of onboarding.
That is incredibly convenient. So say I've been a DIY investor for 10 years. I have a DMA account full of blue chip stocks worth roughly 60 lakhs today. But I'm exhausted, I'm tired of tracking earnings reports. I can literally just hand over my existing stock portfolio, and that counts as my entry ticket.
That is correct. You just transfer the securities from your personal demand account into the newly created PMS demand account. It satisfies the capital requirement perfectly. But, and this is a massive operational reality that catches people off guard, you have to look at what happens the very next day.
Right, because if I hand over 60 lakhs of stocks I handpicked, the new portfolio manager isn't just going to sit on my old choices. They have their own proprietary models. They probably think half my stocks are garbage.
Exactly. They'll immediately evaluate them against their stated strategy.
Yeah.
And if your legacy stocks don't fit, which they almost certainly won't, the very first action the manager takes is to sell all or part of those securities to generate cash to buy their preferred picks. This is called rebalancing.
Okay, stop right there, because alarm bells are ringing. If I hand over my stocks and the manager immediately hits sell, aren't I suddenly triggering a massive tax event? A sale is a sale, right?
You hit the nail on the head. That rebalancing act is a taxable event. It triggers capital gains taxes. Depending on how long you held them, you'll be hit with short-term or long-term capital gains tax. And the crucial part is the portfolio manager doesn't absorb that tax liability.
I do?
You do. It falls entirely on the investor.
So before they've even made a single new investment, before generating 1 rupee of fresh profit, I might be on the hook for lakhs of rupees in taxes just because they liquidated my old portfolio.
That's the harsh operational reality. Say you bought a stock 10 years ago for 5 lakhs. Today it's 20. You hand it to the PMS. They sell it on day 1. You instantly realize 15 lakhs of long-term capital gains, and you owe taxes on that this financial year.
Wow. So you really need to consult a tax advisor before you even walk through the doors. You can't just blindly hand over assets for convenience.
Hopefully not. Sometimes it's more tax efficient to keep your legacy portfolio untouched and fund the PMS with fresh cash.
Okay, speaking of walking through the doors, I noticed a mandate about something called the direct route. What exactly is that?
Oh, the direct route is a profoundly investor-friendly mandate. In the past, wealth management relied heavily on distributors, wealth advisors who'd pitch the PMS to you, and in return, take a percentage of your investment as a commission from the PMS provider. But the new regulation states that investors must have the option to be onboarded directly by the PMS provider, completely bypassing any distributor.
So it's a VIP door where I don't have to tip the promoter to get inside. I assume that means no distributor commissions?
That's the entire point. The regulations state that when you're onboarded directly, no upfront charges, except statutory fees, can be levied. And SEBI mandated that portfolio managers have to prominently disclose this option. They can't hide it.
I love that. Let's do the math, because people underestimate the drag of those fees. Say a distributor takes a 1% trail fee every year. On a 50 lakh minimum, that's 50,000 rupees in year 1. Over 20 years, with compounding, that 1% drag is enormous.
Massive. By bypassing the distributor, you keep that compounding inside your own portfolio. Now, many still choose to use distributors for the personalized advice, which is valid. But the choice must be explicit.
Power to the consumer. Okay, so you've got your 50 lakhs, you've planned your taxes, you've chosen the direct route, and you sit down to open the account. What's the paperwork like? Has it evolved past the usual avalanche of legal jargon?
It has evolved drastically. We're moving from deliberate obfuscation to mandated clarity. The foundational step is still KYC. Know your customer, prove your identity, your PAN card, all that. But the fascinating part is the push towards digital inclusion.
Yes. I saw the May 2025 mandate. SEBI rolled out a directive regarding inclusive digital KYC, specifically demanding integration with assistive technologies.
It's a monumental shift. Historically, digital just meant turning paper forms into PDFs. But a PDF is essentially useless to someone with severe visual impairments. The May 2025 directive mandated that all digital KYC and dashboards must be designed to interact seamlessly with screen readers and voice command software.
Which is so important. Wealth management shouldn't just be a privilege for the able-bodied. If someone built wealth running a business despite a disability, they shouldn't be locked out because the app interface is broken for them.
Precisely. It forces financial tech developers to build empathy and functionality into the code.
Fantastic step forward. But assuming the tech works, you still have to read the contract, and I'm guessing a PMS agreement is a dense fortress of text.
Incredibly dense. It covers liability clauses, fee structures, force majeure. It's designed to protect the institution. And realizing that investors just skip to the signature page, the regulator introduced an absolute game changer, the MITC.
The most important terms and conditions document. Looking at the notes, it feels like a paradigm shift.
It really is. Mandated for new clients starting in October 2024 and retroactive for existing clients by January 2025. The MITC forces the portfolio manager to extract the absolute most critical high-risk information and put it on a single, standardized dashboard.
It's like the warning label on a prescription drug. For decades, they'd give you a massive pamphlet, and on page 42, it says the drug might make your hair fall out. And the regulator finally said, no, put the side effects right there on the bottle.
That's a great analogy. The MITC is the bold print on the bottle. It explicitly states the fee structure, the exit loads, the tenure, the benchmark index, and whether the client allows investments into related parties. And the kicker: the client must explicitly sign this specific, simplified document separately.
Removing the excuse of, I didn't see that in the fine print. I love it. Now, regarding the paperwork, there's a quirk about joint accounts. You can hold a PMS jointly, right?
You can, single, joint, or any one survivor. But here's where people trip up. The operational reality is very rigid. Regardless of how many people are on the account, the primary investment records are created strictly in the name of the first holder.
So the first name matters most.
Entirely. All the tangible financial benefits, dividends, interest, redemption proceeds flow directly to the registered bank account of the first holder. And all the tax liabilities are assessed exclusively against the PAN card of that first holder.
So you have to be strategic about household tax brackets when choosing the first holder. But what if you make a mistake? Can you just add a name later?
No, and this is the trap. A PMS requires a brand new, dedicated DMAT account. And under depository rules, once it's open, the ownership structure is locked in stone. You cannot add a joint holder, delete one, or swap the names.
Wait, really? If I open a single account today and get married next year, I can't just add my spouse?
You cannot. You'd literally have to close the account, liquidate the assets, realize the tax consequences, and open a brand new joint account from scratch.
Wow. Measure twice, cut once.
Exactly. You have to get it absolutely correct on day one.
Okay, so the account is set up. But before they take control of your 50 lakhs, they have to show you their report card. And not the glossy marketing brochure. The regulator demands they show you their filials. Let's examine the disclosure document.
Arguably the most important pre-investment literature you will ever read. It must be provided before any agreement is signed, and it must be publicly available on their website.
And SEBI overhauled this recently, right? September 2025.
Correct. Previously, firms formatted it however they wanted, making comparison impossible. So SEBI mandated a simplified two-part format: the static section and the dynamic section.
Let's break those down. What's in the static section?
The static section is the permanent identity and behavioral history of the firm. Promoters, key directors, top 10 group companies, services offered, accounting policies. But the most striking part is the mandatory disclosure of penalties and pending litigation.
I found this wild. It's like going on a first date, and legally, before you order a drink, they have to hand you a document listing every time they've been sued, arrested, fined, and exactly how much money they make.
That is exactly what it is. It's radical transparency.
Yeah.
The regulator is forcing the manager to introduce themselves by stating their regulatory criminal record up front. Fines by SEBI, pending litigation from former clients, audit deficiencies, it all has to be listed.
It strips away the slick marketing veneer. If they have a history of breaking rules, it's right there in black and white. So that's the static section. What about the dynamic section?
The dynamic section is the current vital signs. client representation, total assets under management, the financial performance of the PMS company itself.
Wait, like, are they actually profitable as a business?
Yes, exactly. You need to know if the corporate entity managing your money is burning cash. It also shows the audited 3-year performance track record. But the most critical element, the highest potential for abuse, is the disclosure regarding investments in related parties.
Okay, related party investments. The moment I read that, alarms went off regarding massive conflicts of interest.
And they should. A related party is an associate company that the PMS provider or its parent conglomerate owns or controls. Historically, this was a systemic risk.
Let's role-play this to see how dangerous it is. Say I invest 50 lakhs with Apex Wealth Management, but Apex Wealth's parent company, Apex Corp, has a real estate wing. And that real estate wing is failing. They built luxury apartments, nobody's buying, they're bleeding cash, no bank will lend to them. What was stopping the portfolio manager from using my 50 lakhs to buy risky corporate bonds issued by their own failing sister company?
In the past, very little. They could easily funnel client money into the struggling debt of their associate companies to bail them out. They'd use your wealth as a slush fund for their corporate empire and justify it on paper by saying, "We believe these bonds are a good investment."
Using my hard-earned money as a life raft for their parent company's bad decisions? That's terrifying. So how does the current regulations stop that?
The rules are incredibly draconian now. First, the manager cannot invest a single rupee into their associate companies without obtaining your prior positive written consent. You have to explicitly read a document detailing it and say, "Yes, I allow this."
And what if I say, absolutely not, don't touch your sister companies?
The form must prominently feature a clear option to indicate outright dissent. You have total veto power. If you check opt-out, they are legally barred from ever investing your funds in their related entities. Or you can set a strict limit, like maximum 5%. And they have to maintain exhaustive records of these consents and report them.
So I hold all the cards. That's a massive relief. All right. Disclosures read, MITC signed, boundary set, 50 lakhs deployed, paperwork is done. But how do we know the actual human beings trading your money aren't up to no good? Let's step inside the black box, the dealing room.
The dealing room is the beating heart. This is where the strategy becomes actual financial transactions. And because the volume of money is so staggeringly high, the temptation for malpractice is acute. So the regulator imposes operational rules that are, frankly, severe: isolation and relentless surveillance.
Paint a picture. If I walk into a modern PMS office, what does the dealing room look like?
Like a secure government facility. Entry is strictly restricted by biometric access to authorized personnel only. No casual wandering. Once inside, mobile phones, smartwatches, any personal devices are strictly banned. They are locked outside.
No phones at all in the modern era.
Zero. If they need to communicate, it happens on dedicated, hardwired telephone lines that are automatically recorded and archived. Even their computer terminals are locked down by firewalls. They can only access trading platforms. No web browsing, no personal email.
Let me just pause. We are treating elite, highly paid financial traders like high school students taking a standardized test. Pencils only, no phones, locked doors, recorded conversations. It's the complete opposite of the screaming 1980s Wall Street trading floors. It's a silent, hyper-monitored vault. As an investor, I love it, but what specific crime requires a vault to prevent?
The entire architecture is designed to prevent insider trading, and more specifically, front-running.
Front-running. Explain the mechanics. How does banning cell phones stop it?
Front-running is trading on advanced, non-public knowledge of a massive transaction that will move the market price. Imagine you're at a real estate auction. You know a massive corporate developer is about to walk in and place a bid so high it'll double neighborhood property values.
Okay, secret knowledge of a market-moving event.
Right. If you have your cell phone and you text a friend, "Buy the house across the street right now," your friend buys it. 10 minutes later, the developer drops their bid, prices skyrocket, your friend sells for a massive profit, and you split the cash. You front-ran the big bid.
I use the knowledge of my client's massive order to enrich myself.
Exactly. In the stock market, this happens in milliseconds. A PMS dealing room might be preparing to buy 2 million shares of a small mid-cap company. That massive order will eat up supply and drive the price up. If a trader has a phone, They text a buddy to buy 50,000 shares in a personal account just seconds before the PMS places the massive order. The price surges, the buddy sells at the peak, they split the profit.
And the victim is the PMS client because the front runner bumped the price up slightly before the massive order went through. The client ends up paying a slightly higher average price. The trader is stealing pennies millions of times over.
Precisely. Theft through market mechanics. By isolating the dealing team, locking away phones and recording lines, the regulator mathematically destroys the mechanism for front-running. The trader cannot transmit the secret knowledge to the outside world.
Cut off the communication, cut off the crime. It's fascinating how a physical room is a regulatory tool. But I also read a rule that applies to the mega funds managing over 1,000 crores. What changes for them?
When a PMS reaches a certain scale, human intervention itself is a risk. SEBI mandates that for any PMS with assets under management of 1,000 crores or more, they must implement a fully automated system for order management and allocation with minimal manual intervention.
Why does automation become mandatory just because the fund gets bigger? What's the human risk?
At that scale, the risk shifts from front-running to favoritism. Say a manager buys 100,000 shares of Reliance for 50 different clients. They don't buy it all at once. They buy in batches throughout the day at varying prices.
Right. The price fluctuates.
At the end of the day, they have to allocate those shares to the 50 accounts. If a human does this manually, there's a massive window for corruption.
Oh, the manager gets to decide who gets the cheap shares and who gets the expensive ones.
Precisely. A corrupt manager might allocate all the shares bought at the lowest price to one massive, ultra-wealthy corporate client, a whale, to keep them happy, and they dump all the highest priced shares into the accounts of the smaller retail clients.
Subsidizing the whale's returns by secretly taxing the smaller clients, and you'd never know as a small investor.
Exactly. You just see you bought the stock. You wouldn't know you got the worst price. This is why the 1,000 crore rule exists. Automation forces mathematical fairness. The software calculates the weighted average price of all transactions and distributes the shares pro rata across all accounts at that exact identical average price.
Removing human bias completely. Everyone gets the exact same execution price.
Yes, and it creates an unalterable, time-stamped audit trail down to the microsecond.
So the dealing room is secure, the whales can't eat the little guys, but all this infrastructure, the software, the biometrics, the compliance teams, it's not free. It costs a fortune, which trickles down to the investor. So let's pivot to fees, costs, and exit loads.
This is where the alignment of interests is truly tested. The regulatory framework ensures fees are transparent and tied to performance. And the baseline protection is the total prohibition of upfront fees.
They can't charge me a massive fee just for signing the paperwork?
Correct. 10 years ago, managers would charge a 1 or 2% setup fee. You bring in 50 lakhs, they instantly deduct a lakh before buying a single stock. SEBI recognized this was predatory and abolished it. You do not pay a toll just to enter.
Good. But there are ongoing operating expenses, right? I saw a specific regulation capping those.
Yes, a PMS incurs legitimate administrative costs, third-party fund accounting, audits, secure custody fees. SEBI allows them to charge the client, but imposes a hard cap. These operating expenses, excluding brokerage, cannot exceed 0.50% per annum of the average daily AUM.
Let me play devil's advocate. 0.5% sounds tiny. Oh, it's just 0.5. But 0.5% of 50 lakhs is 25,000 rupees every year just for basic admin. If I have 2 crores, I'm paying a lakh a year before management fees or brokerage. Are investors getting nickel and dimed?
It's a valid concern, which is why the cap is necessary. Without it, firms could bury their own corporate overhead office rent, executive travel, into the client's expenses. The cap forces them to be highly efficient and negotiate better rates with their custodians. And brokerage is charged at actuals. They can't add a markup to make a hidden profit.
Okay, the transparency helps, but what if after 6 months I realize I hate the service and want my money back? They can't hold my money hostage, right?
They cannot. You always have the right to redeem. However, to discourage hot money rapidly entering and exiting, they can charge an exit load.
A penalty fee for breaking the contract early.
Exactly. And SEBI mandated a strict descending scale. If you leave in the first year, maximum 3% exit load. Second year, maximum 2%. Third year, maximum 1%. And crucially, after 3 full years, the exit load drops to absolute 0.
A 3-year descending staircase. 3, 2, 1, 0. That makes sense. It enforces commitment and lets the manager take long-term bets without fearing everyone will panic withdraw.
Precisely. It aligns the timelines.
But let's talk about the big money, the performance fees, because the math here is genuinely fascinating. I want to dive into two concepts, the hurdle rate and the high watermark. Let's start with the hurdle rate.
The hurdle rate is the ultimate performance baseline. It's a pre-agreed minimum rate of return the manager must achieve before they can charge a single rupee of performance fee.
So if my hurdle rate is 10% and they only grow my portfolio by 8% in a mediocre year, what happens?
They failed to clear the hurdle. They get absolutely zero performance fee for that year. They still collect their fixed baseline management fee, but they don't get the bonus.
I love that. But what if they have a spectacular year? The hurdle is 10%, but they generate a 25% return. Do they charge a fee on that entire 25% pie?
No. They only charge on the excess return, the portion above the hurdle, so they calculate the fee only on that 15% outperformance. The first 10% is yours, untouched.
That is a phenomenal structure. But the high water mark seems even more critical for long-term investors enduring multi-year market cycles.
If the hurdle rate protects you in a single year, the high water mark protects you across a decade. It states a manager can only charge a performance fee on net positive returns that exceed the highest historical value your portfolio has ever reached.
Okay, we need to walk through a multi-year scenario. Let's invent an investor, Sarah. She invests exactly 1 crore rupees, that's year one.
All right. That initial 1 crore establishes her very first high water mark, the baseline peak. Now, say the manager does a phenomenal job in year one. By the end of the year, Sarah's portfolio grows from 1 crore to 1.2 crore.
A 20 lakh profit. The manager takes their performance fee out of that 20 lakh gain.
Yes, they do. And critically, a brand new high water mark is established at 1.2 crore. But now, year two is an absolute disaster. Market crashes, portfolio plummets from 1.2 crore all the way back down to 1 crore.
Devastating. So obviously no performance fee in year two because there are zero profits.
Correct. Now we enter year three, the market recovers, the portfolio climbs from 1 crore up to 1.15 crore.
Let's pause. In year three alone, the manager generated 15 lakhs of growth. Do they charge a performance fee on that 15 lakh gain because it's a positive return for that specific year?
No, they get absolutely nothing. This is the magic of the high water mark. Sarah's historical peak is still sitting at 1.2 crore from year one. Even though they made 15 lakhs in year three, they're still just digging Sarah out of the hole they put her in.
So the manager doesn't get paid a bonus just for fixing their own mistakes.
Exactly. Why pay a premium fee for recovering money they lost you? You shouldn't. Now, year four. The bull market returns. The portfolio surges from 1.15 crore up to 1.4 crore.
We crossed the threshold. The old peak was 1.2 crore. So in year four, they finally charge a fee, but only on the wealth created above the historical peak, right?
You've mastered the concept. They only calculate the fee on the 20 lakhs of growth between the old peak of 1.2 and the new peak of 1.4. It ensures you only ever pay performance fees for genuine net new wealth creation.
Incredibly reassuring. No double dipping on volatility. But how do they report these complex returns to you? With cash flowing in and out, you can't just look at a simple balance.
Reporting is the lifeblood of transparency. SEBI mandates a comprehensive performance report at least once every 3 months. And it can't just be a vanity number. It must show the full portfolio composition, every transaction, all expenses, and explicitly disclose any underlying risks like corporate debt defaults.
So they can't hide bad news?
No. But calculating the rate of return is the complex part. The regulator mandates 2 specific metrics: the time-weighted rate of return, or TWRR, and the extended internal rate of return, or XIRR.
Okay, TWRR and XIRR. Why do we need 2 formulas just to tell me how much I made? Which one is true?
They're both true, but answer different questions. Let's start with TWRR. It measures the pure performance of the investment strategy itself, explicitly neutralizing and ignoring the disruptive effects of your external cash flows.
Meaning it pretends I never put money in or took money out.
Exactly, because the manager doesn't control your wallet. Say the strategy's up 15%, doing brilliantly, but right before a massive, unpredictable market crash, you suddenly deposit another 50 lakhs. The market crashes, your new money loses 20%.
So my account value plummets because of my terrible timing.
Right, but is that the manager's fault?
Yeah.
No. If we judge the manager based on your terrible timing, it'd be unfair. TWRR calculates the return independent of cash flows. It judges the manager purely on their stock-picking skill.
Okay, so TWRR is like grading a university professor strictly on how good their syllabus and lectures are, completely regardless of which students actually show up to class.
That's a great way to look at it. But XIRR does the exact opposite. XIRR embraces the chaos of your cash flows. It assigns specific calendar dates to every single deposit, withdrawal, and fee deduction. It calculates the return based on exactly what your specific money experienced.
So XIRR is grading the specific, chronically late student who skipped the first 3 weeks of class, showed up right before midterms, and left early on Fridays.
Perfect analogy. You need both grades to understand reality. The TWRR tells you if the strategy works in theory. The XIRR tells you what your wallet experienced in practice. A manager might boast a brilliant 20% TWRR on their brochure, but because you invested right before a major dip, your personal XIRR on your statement might only be 5%.
And the regulator mandates they show me both, so they can't hide behind the brochure number.
Not only must they show your personal XIRR, they must show you the minimum, maximum, and median XIRR across all investors in that exact strategy.
Wow, so I can see exactly where I rank. If I'm at 5% and the median is 15%, I instantly know my timing was terrible.
Exactly. It destroys the illusion. The reports must also include a mandatory disclaimer explaining exactly why your individual performance might vary from the aggregate strategy due to your specific cash flow timing.
Deeply empowering. Now, while reviewing the framework, I noticed the PMS isn't just reporting to the client, they're reporting to the government. And not just taxes. There's a compliance requirement regarding the FIUIND.
Yes, the Financial Intelligence Unit, India. This shifts our perspective to overarching national security. Under the Prevention of Money Laundering Act, or PMLA, portfolio managers are essentially deputized by the state to act as the first line of defense against financial crime. They must implement an exhaustive anti-money laundering policy.
What does that look like in practice? We usually think of money laundering as guys with duffel bags of cash in a casino, not elite stock portfolios.
In high finance, it's about layering and integration. Criminals try to inject illicit funds into the legitimate system to obscure the origin. In practice, the PMS has to actively monitor their clients' behavior and transactions for anomalies.
Like what?
Say a client whose KYC says they are the mid-level salaried employee suddenly wires 5 crores from an offshore shell company in a tax haven. Or they engage in rapid, nonsensical trades with highly illiquid stocks at bizarre prices, seemingly just to transfer wealth to another account. That is highly suspicious.
And when they detect this, do they confront the client?
Absolutely not. They do not tip off the client. They're legally obligated to file a suspicious transaction report, or STR, directly to the FIUIND within 7 working days. They freeze the data, package the evidence, and hand it to federal investigators.
It's crazy to realize the firm managing your retirement is actively hunting international money launderers. Okay, let's take stock. Reporting is tight, fees are mathematically fair, dealing room is a fortress. But what if things still go south? A rogue manager, fraudulent reporting, they refuse to fix an exit load error. A retail investor against a billion-dollar institution isn't a fair fight. Let's look at dispute resolution.
You need to know your avenues of recourse. First, the overarching power of SEBI. If a manager willfully contravenes regulations or engages in fraud, SEBI has a terrifying arsenal of disciplinary actions.
What can they actually do?
They can suspend the firm's certificate of registration, paralyzing the business. They can cancel it entirely, shutting them down. They can legally debar the principal officers from the capital markets, ending their careers. The constant threat of SEBI action keeps the industry honest.
That's great on a macro level, but SEBI shutting down a firm doesn't get my 50 lakhs back. Or solve a granular argument about an exit load calculation. I don't want to hire a massively expensive lawyer for civil court. What is the immediate mechanism for my specific dispute?
This is an area where the Indian financial system got a genuinely revolutionary upgrade. In July 2023, SEBI introduced a mandatory online dispute resolution mechanism, the ODR portal. It's a formalized, time-bound, escalating ladder of intervention.
Let's walk through it. Say the PMS wrongly charged me a 3% exit load in year 2 instead of 2%. My relationship manager dismisses me. What's step 1?
Step 1 is logging your grievance on Scores, SEBI's centralized online complaint system. A ticking clock starts. The PMS is legally mandated to resolve it and respond formally within a strict timeline, usually 21 days. It forces them to stop ignoring you.
Okay, 21 days pass, and they say, we calculated it right, go away. Internal complaint failed. Now what?
Now you trigger the actual ODR process, you escalate to the portal. This initiates pre-conciliation. The system auto-assigns your dispute to a marketing infrastructure institution, or MII, like a recognized stock exchange.
Does a judge get involved yet?
No. The MII facilitates an informal, amicable discussion between you and a senior rep of the PMS. They act as a neutral observer to try to clear up what might just be a stubborn misunderstanding.
Say the PMS remains stubborn. Pre-conciliation fails. Do I need a lawyer?
Still no. You escalate to conciliation. This is a formal negotiation. The MII appoints an independent, neutral conciliator who actively works with both sides. They review the math and try to broker a legally acceptable settlement. It's professional mediation.
Sounds reasonable. But worst case scenario, the PMS acts in bad faith, refuses to settle, won't refund my money. What's the final step?
Arbitration. The conciliator steps away, and the MII appoints a formal arbitrator. This is a quasi-judicial process. They review all evidence, hear arguments, and issue a binding legal arbitration award. They rule on who is right and order financial restitution.
Now, historically, corporate arbitration is biased. The massive corporation gets to pick the arbitration firm, creating a repeat player bias. The arbitrator knows if they rule against the huge PMS, they'll never get hired again. How does the ODR system prevent this corruption?
You've correctly identified the historic flaw. And this is why SEBI's ODR is revolutionary. It completely eliminates the repeat player bias through an algorithm. When your dispute enters the portal, it's auto-assigned to an MII based on a computerized round-robin logic system.
Round-robin meaning it just cycles through a list randomly.
Yes, neither the investor nor the PMS gets to choose the institution or the arbitrator. The algorithm enforces complete neutrality mathematically. The massive PMS cannot collude because they have no idea who the algorithm will assign. It levels the playing field.
Incredible systemic engineering. But what if the neutral arbitrator rules against me and I genuinely believe they misinterpreted the law? Am I locked out of the real courts forever?
No, you retain your fundamental right to appeal the decision in the traditional jurisdictional court system.
So it's not a replacement for the court.
Exactly. It's a massive, highly efficient filter. It provides a fast, cheap, mathematically neutral first resort that solves 95% of grievances without clogging the traditional courts while preserving your ultimate right to a trial.
Phenomenal safety net. Well, let's take a breath and summarize this incredible journey. We started outside the restaurant, and we've fully inspected the financial kitchen.
We really have.
You've walked through the VIP doors, establishing your 50 lakh minimum, navigating the tax hits and the direct route to save on fees. You bypassed the fine print via the MITC document and ensured digital KYC was inclusive. You learned the hard truth about getting your joint account DMAT structure perfect on day one. You scrutinized the manager's regulatory rap sheet in the disclosure document, setting boundaries on related party investments. You stepped inside the biometric lockdown of the dealing room where front-running dies and algorithms guarantee equitable execution prices. You protected long-term profits with the high water mark and hurdle rate. You learned to read your quarterly report card, balancing TWRR and XIRR while acknowledging the FIU-IND anti-money laundering protocols. And finally, you established a rock-solid, mathematically neutral safety net with the ODR ladder. That is a comprehensively engineered, heavily armored vehicle for your wealth.
It is a world-class framework. We spent this hour looking at the airtight regulations and surveillance systems designed exclusively to protect your assets. The regulator built a masterful glass wall. But as we wrap up, here is something I want you to consider. Something beyond the rules.
Oh, lay it on us.
Does this massive operational burden to porn, the intense compliance audits, the recorded landlines, the inability to use a cell phone, the algorithmic trading mandates, does all of this friction actually stifle the very financial creativity, agility, and risk-taking that you are paying an elite portfolio manager to execute? If an analyst can't quickly message a contact for context on a breaking news story because they're locked in a clean room, do they miss a trade? At what point does perfect algorithmic safety become the enemy of exceptional market-beating returns?
Wow, that is a fantastic, deeply philosophical question to leave off on. If you lock the master chef in a sterile cage, confiscate their outside ingredients, and legally dictate every single movement of their knife, can they still create a masterpiece? Or do they just end up making a perfectly safe, perfectly compliant, incredibly boring bowl of oatmeal? That is the tension of modern wealth management, something for you to mull over as you review your own portfolios. Remember, whether you're dollar cost averaging into a mutual fund or walking through the velvet rope doors of a PMS, the rules of the game dictate the outcome. And being well-informed is the ultimate alpha. Thanks for joining us on this deep dive into the operational kitchen of wealth management. Stay curious, stay informed, and we'll catch you next time.